So it's been over a year since oil prices came down, and there's probably not a single company in the oil and gas industry that hasn't taken a close look at its costs by now. And we're starting to see the results of that, with savings of 20, 30, sometimes 40% being reported. But as we look at the actual income statements of companies across the sector, we're seeing that operating costs in particular are sticky, and savings average out at around 10 to 12% at this time. So more is needed still, and more is possible. But as companies enter into their second or third waves of cuts, we're also starting to see tension in areas where further reduction might be penny-wise, but pound-foolish, frankly. So a classic example is maintenance. It's always possible to push out a piece of maintenance for another few months. But that's a slippery slope, and it's much more expensive to fix something once it's broken. And we've seen instances where the cost of lost production outweighs the original savings by an order of magnitude. Another area of tension is in supplier relationships. Many companies would have sent out letters to their suppliers asking for rate cuts, which is certainly appropriate in this environment. But the best procurement teams we've seen have actually started to work together much more closely with their suppliers to look at ways to eliminate costs together. For example, by simplifying their joint processes, or actually taking input from their suppliers on design specifications. Our advice to procurement teams in this market environment is to maintain a strategic perspective. That means strengthening category management, really understanding the trade-offs involved in cost reductions, understanding the risks involved, investing in supplier relationships, and finally working together with the rest of the business to provide tools, to provide transparency for teams to generate their own savings initiatives from the bottom up.